Welcome to the Deep Dive. Today we're going deep into mergers and acquisitions, a world that shapes industries and makes headlines.
It's a fascinating area.
We're going to break it all down using Mergers, Acquisitions, and Corporate Restructurings by Patrick Gaughan. It's a fantastic guide, the 7th edition. By the end of this deep dive, you'll have a solid grasp of how these big deals work.
What I find really intriguing is how dynamic this field is.
Right.
It's way more than just companies combining. You have to consider market forces, financial strategies, even the personalities involved.
This is so true. Let's start with the basics. What exactly is a merger and how is it different from an acquisition?
Well, to put it simply, a merger is like a corporate marriage.
Okay.
Two companies come together and they form a whole new entity.
Got it.
Think of the merger between Burroughs and Sperry back in 1986, which created Unisys.
Right.
Now, an acquisition, that's more like a takeover.
Right.
One company, the acquirer, takes control of another company, the target.
So a merger creates something new, and an acquisition is one company absorbing another.
Precisely.
Makes sense.
And just like in relationships, acquisitions can be friendly or hostile, depending on how the target company feels about being acquired.
Gaughan talks about horizontal, vertical, and conglomerate mergers. Can you unpack this for us?
Sure. Imagine two car manufacturers deciding to combine forces.
Yep.
That's a horizontal merger companies at the same level of the supply chain joining up.
I see the appeal, combining resources, eliminating competition.
Exactly. Now, let's say a car manufacturer acquires a tire company.
Right.
That would be a vertical merger. Companies at different stages of production, but within the same industry, coming together.
To control more of the supply chain.
You got it. Now, conglomerate mergers, that's where it gets interesting. This is when companies in totally different industries decide to merge, like, say, a tech company acquiring a food company.
What's the strategy behind that kind of deal?
It's often about diversifying, reducing risk.
Yeah.
They're less vulnerable to downturns in any one industry.
Makes sense. Now, Gaughan also talks about these merger waves throughout history. Can you walk us through those?
Yeah, absolutely. There have been 6 major merger waves in U.S. history, each triggered by different factors. The first wave, from 1897 to 1904, saw the rise of industrial giants, figures like J.P. Morgan and Andrew Carnegie.
Monopolies, trusts like Standard Oil.
Exactly. Then in the second wave, from 1916 to 1929, the focus shifted to conglomerate mergers and vertical integration. Companies wanted to control more of the production process.
Okay, so companies were getting more strategic.
Yeah. Wave 3, from 1965 to 1969, was all about conglomerates in the price earnings game. But a lot of these conglomerates weren't well managed and their performance declined.
So acquiring companies wasn't enough. You had to have a good plan to manage them effectively.
Right. Then came the 1980s, the era of the corporate raider. Wave 4, a lot of hostile takeovers, leveraged buyouts. Think Carl Icahn.
Leveraged buyouts, we'll have to delve into that later.
Sure. Then Wave 5, the 1990s, fueled by strategic deals and the rise of the dot-com bubble. Rapid innovation and, well, some spectacular crashes.
The dot-com bubble, a reminder that growth can be risky. And finally, Wave 6, from 2004 to 2007.
This wave was driven by readily available debt and the rise of private equity firms.
Gaughan points out that M&A activity often mirrors economic trends. Why is that?
When the economy is strong, companies have more cash and confidence to take risks. Take a look at Figure 1.2 in Gaughan's book. It shows how deal volume follows economic upswings.
M&A is more than just corporate strategy. It reflects the economy as a whole.
Precisely.
Let's talk about the people who make these deals happen. Who are the major players in the M&A landscape?
You have your investment bankers. They're the deal makers, connecting buyers and sellers, advising on structure and financing.
They're like the architects of these complex deals.
Yes, they really have their finger on the pulse of the market.
Yeah.
They know who's buying, who's selling, how to structure a deal that works.
Right. Who else is involved?
You have legal advisors to make sure everything is legally sound and compliant, to make sure every I is dotted and T is crossed.
Important, because mistakes can be costly.
Absolutely. And then you have the accountants, scrutinizing the financials of both companies, making sure everything adds up. Due diligence can uncover some interesting things.
I bet.
And let's not forget the merger arbitrageurs, the gamblers of the M&A world.
Oh.
They bet on the outcome of announced deals, looking to profit from price differences.
Sounds risky. Gaughan mentions some leading firms in each of these categories in tables 1.5 and 1.6. It's like a who's who of the M&A world. Let's talk about the rules of the game. What's the legal and regulatory framework?
One of the most important laws is the Williams Act of 1968.
Okay.
It was enacted to protect target company shareholders by promoting transparency and fair play.
To prevent backroom deals that hurt shareholders.
Exactly. For example, the Williams Act requires bidders to disclose their intentions and holdings when making a tender offer. It also gives shareholders time to consider their options.
That makes sense. What other regulations are there?
You have state anti-takeover laws, international securities laws, and, of course, antitrust laws.
Right.
These are designed to prevent monopolies and maintain a competitive market.
To make sure mergers don't hurt consumers by stifling competition?
Exactly. Gaughan has a whole chapter on antitrust, which we'll get into later. But for now, keep in mind that any deal that could reduce competition will be scrutinized by the Justice Department and the FTC.
They can block deals or force companies to sell off assets to maintain competition. Gaughan uses Tyco as an example. They made so many small acquisitions in the 1990s that it was hard to track what they were doing.
It shows how companies are always trying to push the boundaries and regulators are trying to keep up.
Okay. Now, let's talk about valuation. How do you put a price on a company, especially in a fast-paced and subjective market?
That's a million-dollar question. There's no easy answer. It involves analyzing financials, market position, growth potential, lots of factors.
And I imagine things get emotional with competing bidders trying to outbid each other.
Absolutely. That's where fairness opinions come in.
Okay.
Independent assessments to make sure shareholders are getting a fair deal.
Like a reality check to ensure the price is justified.
Precisely.
Yeah.
But even with those, it's complex. There's an element of art and science involved.
Now, let's move on to deal structures and negotiations. What are the different ways to structure these M&A deals?
One key distinction is between asset deals and entity deals.
Okay.
In an asset deal, the buyer acquires specific assets of the target company, factories, patents, customer lists.
Like choosing what you want from a buffet.
Yes. The buyer avoids inheriting any unknown liabilities. They're only responsible for the liabilities tied to the assets they buy.
A way to minimize risk.
Exactly. For the seller, an asset deal can be good for taxes. They might pay less in taxes compared to selling the whole company.
Interesting. So there are tax benefits for both sides depending on the structure. What are some drawbacks of an asset deal?
Well, one downside for the buyer is that negotiating and executing the deal can be more complex and time-consuming. Imagine valuing and transferring each asset individually. Lots of paperwork.
The lawyers must love those deals.
They do. For the seller, one downside is that they might not get as high a price for their assets as they would for selling the whole company as a going concern.
It's a trade-off. You have to weigh the benefits against the potential for a lower price.
Right. Now, entity deals are more comprehensive. The buyer acquires the whole company, assets, liabilities, contracts, employees, everything.
Like buying a house with everything in it, including the mortgage?
Exactly. The advantage for the buyer is that it's simpler. They get everything, no need to pick and choose.
Sounds straightforward. What about from the seller's perspective?
An entity deal can often fetch a higher price because they're selling a complete, functioning business.
It's like selling a ready-to-go business. The buyer just steps in, but I imagine there are downsides too.
Yes. The biggest risk for the buyer is inheriting hidden liabilities. You know, those skeletons in the closet we talked about earlier.
Those hidden risks you might not find during due diligence.
Right. Those become the buyer's problem in an entity deal, and the seller might pay more in taxes compared to an asset deal.
So again, it's all about weighing the pros and cons of each structure.
Precisely. And sometimes you might even use a combination of asset and entity structures to get the desired outcome.
So it's not always black and white. Now, Gaughan goes into more complex entity deal structures, forward subsidiary mergers, and reverse subsidiary mergers. Can you break those down?
Of course. Let's say a company wants to buy another company but keep the target's operations separate. They might use a forward subsidiary merger.
Like creating a separate division or subsidiary for the acquired company.
Exactly. The acquiring company creates a subsidiary, and that subsidiary merges with the target. The target company no longer exists, and its assets and liabilities become part of the acquiring company's subsidiary.
So it's a way to isolate the acquired company and its potential problems. What about a reverse subsidiary merger?
In a reverse subsidiary merger, the acquiring company's subsidiary merges into the target. So the target company survives, but becomes a subsidiary of the acquirer.
It's the opposite. The target company absorbs the acquiring company's subsidiary.
Right. And these subsidiary merger structures can be beneficial for several reasons. They can simplify the transfer of assets and liabilities, make shareholder approvals easier, and sometimes even have tax advantages.
It seems like structuring these deals involves a lot of strategic thinking.
Absolutely. Choosing the right structure is crucial because it impacts the legal, financial, and tax aspects for both sides.
Okay, so we've covered the basic structures. Now, what happens when a company decides to acquire another and they've figured out the structure? How do they actually negotiate the deal?
It usually starts with an initial agreement. It might be called a term sheet or a letter of intent.
A preliminary agreement before things get serious.
Right. It outlines the main points: the price, the payment method, the major conditions. It sets the stage for the detailed negotiations.
And these initial agreements, are they legally binding?
It depends on the specific terms. So it's important for both sides to have their lawyers look over everything carefully.
Gaughan emphasizes the importance of confidentiality agreements at this stage. Why is confidentiality so crucial in M&A?
Well, think about it. When two companies are exploring a merger, they're sharing a lot of sensitive information today. Financials, customer lists, trade secrets. If that information leaks, it could be really damaging.
So confidentiality agreements protect these sensitive negotiations.
Exactly. And these agreements often include standstill agreements, preventing the buyer from, say, buying up the target stock or launching a hostile takeover for a certain period.
Like a truce to allow for good faith negotiations.
Right. Now, once confidentiality is established and you have that initial agreement, the next step is due diligence.
The detective work begins.
Exactly. Due diligence is about verifying the information from the target company, uncovering potential risks, making sure everything is as it seems. It's a deep dive into their financials, contracts, customer relationships, operations, even legal compliance.
I'm sure you find some interesting things.
Absolutely. And it's crucial for the buyer to decide whether to proceed and how to structure and price the deal.
So the buyer could still walk away.
Absolutely. If they find any serious problems during due diligence, they can end the negotiations. Or they can renegotiate the terms.
Okay. And if everything checks out during due diligence,
Then it's time to draft the merger agreement, the final, legally binding contract with all the details of the deal.
from handshake to a formal agreement.
Exactly. The merger agreement covers everything: the purchase price, payment method, representations and warranties, closing conditions, what happens if the deal falls apart. It's very detailed.
Sounds like you need good lawyers.
You definitely do.
Yeah.
Once that's signed, you're getting close.
But there are still some things to do before the deal is finalized, right?
Yes. Getting regulatory approvals is often a key condition. Remember those antitrust laws. If the deal raises concerns about competition, they'll need approval from the regulators.
So even if both companies agree, the government can still stop it.
Exactly. And there could be other conditions: shareholder approval, meeting certain financial targets.
It's a final checklist before the deal is official.
Right. And the closing is when all the documents are signed, the money is paid, and ownership of the target company officially transfers to the buyer.
A culmination of years of planning and negotiation.
It can be a really exciting time.
Now, besides the legal and regulatory hurdles, I'm guessing financing these deals is a challenge.
It can be incredibly complex, especially for large deals.
So how do companies pay for these acquisitions?
They might use their own cash, issue new stock, or take on debt.
A mix of paying with savings, trading possessions, and borrowing money.
That's a good way to put it. The specific mix depends on the deal's size, the acquiring company's financial health, and the interest rates at the time.
We've talked about investment bankers. Can you elaborate on how they help with this M&A financing?
They advise companies on the best financing options, helping them secure loans, structure debt offerings, and even underwrite stock offerings.
Connecting companies with the right sources of capital?
Exactly. They're experts in capital markets with a wide network of contacts. They can find the best financing terms.
Speaking of financing, Gaughan talks about leveraged buyouts, LBOs, as a tool for private equity. What are those?
In an LBO, a private equity firm uses a lot of borrowed money to acquire a company.
It's like using a mortgage to buy a house, but on a much bigger scale.
Exactly. They often use the acquired company's assets as collateral for the loan and use the company's cash flow to make the loan payments.
Those LBOs sound pretty risky. If the company doesn't do well, the private equity firm could be in trouble.
They can be. High risk, high reward. If the company improves, the private equity firm can make a lot of money. But if it struggles, that debt can be a huge burden.
It's a calculated gamble. Private equity is known for finding undervalued companies and improving them.
They often bring in their own management, improve operations, and focus on efficiency and profits. If they're successful, they can sell the company for a much higher price.
We've covered a lot: deal structures, negotiations, financing, private equity. It's clear that M&A is a complex world.
It is. And we haven't even gotten into specialized areas like cross-border M&A, hostile takeovers, and antitrust law.
Lots to learn. But let's shift back to the human side of things. We talked about communication and leadership during integration. What's it like for the employees of a company that's being acquired?
It's an important question, and it often gets overlooked.
It's more than just numbers for them. It's their jobs, their livelihoods.
Right. A merger can be a very uncertain time for employees. They might worry about losing their jobs, changes to their roles, or having to adapt to a new culture.
Especially when two very different companies merge.
Absolutely. Cultural clashes are common, and they can lead to conflict, low morale, and lower productivity.
So what can companies do to make the transition easier for employees?
Communication is key. Being open about the reasons for the deal, the potential impacts, and the vision for the future.
People are more likely to accept change if they understand why it's happening.
Exactly. It's also important to involve employees in the integration, giving them a voice.
So not just dictating changes, but collaborating.
Right. And companies need to support employees during this transition training, career counseling, maybe even helping them find new jobs if their positions are eliminated.
Acknowledging that these deals have a human impact and providing support.
Exactly. When companies take care of their employees during a merger, it helps the transition go smoother and can even lead to a more successful integration.
Because ultimately it's the people who make these deals work.
You're absolutely right. A merger might look good on paper, but it's the people who have to make it happen.
Okay, so communication, leadership, and employee support are all crucial during integration. You mentioned fairness opinions earlier. Can you tell us more about how those protect shareholders?
Sure. Fairness opinions are independent assessments of a deal's value. They're often required by regulators or a company's board to make sure shareholders are being treated fairly.
So it's like getting a second opinion.
Yes. Let's say a company's board is thinking about selling to a private equity firm, and some board members have connections to that firm. That's a conflict of interest.
It raises questions about whether the deal is really in everyone's best interest.
Exactly. Getting a fairness opinion from an independent investment bank assures shareholders that the deal's terms are fair.
So the bank is a neutral third party.
Right. And fairness opinions aren't just rubber stamps. They're detailed reports that explain the analysis and justify the opinion.
It's about transparency and accountability.
Exactly. Fairness opinions are particularly important for institutional investors, pension funds, mutual funds. They need to be able to justify their decisions, and fairness opinions give them the evidence they need.
It's all about protecting shareholders and making sure deals are fair and transparent. We've covered so much in this deep dive. The different types of mergers and acquisitions, the laws and regulations, the complexities of structuring and financing deals, the importance of managing the human side of things. What are the key things you hope listeners will take away from this?
Well, I think the most important takeaway is that M&A is a complex and constantly changing field. There's no one-size-fits-all approach. Every deal is different.
It's not just about numbers. It's about the strategy, the legal aspects, and the human impact.
Right. And another key point is that successful M&A requires careful planning, great execution, and understanding both the financial and human elements.
Finding that balance between vision, financial discipline, and caring for the people involved.
Exactly.
Now, before we wrap up this part, what are your thoughts on the future of M&A? What trends are you seeing?
That's a tough question. M&A is always evolving with new challenges and opportunities, but there are a few things I'm keeping an eye on.
Let's hear them.
First, I think we'll see more cross-border M&A. Companies are becoming more global, and they want to expand into new markets through acquisitions.
So more deals with companies from different countries.
Yes, and that brings its own complexities, different legal systems, regulations, and cultural differences.
Sounds like you need specific skills for cross-border M&A. What else?
Technology is playing a bigger role. We're seeing new tools and platforms that streamline the M&A process.
So technology makes deals happen faster.
In some ways, yes, but it's just a tool. It's still the people using those tools who determine whether a deal is successful.
Technology can't replace human judgment and expertise.
Exactly. And there's a growing focus on ESG, environmental, social, and governance factors in M&A. Investors are paying more attention to a company's ESG performance.
So it's not just about profits anymore.
Right. Companies with strong ESG practices are often seen as better acquisition targets because they're less risky and better positioned for the future.
Interesting how these non-financial factors are becoming so important. Anything else?
Shareholder groups are becoming more active. We're seeing more activist investors pushing for changes, including in M&A.
So shareholders are making their voices heard.
Yes. It's pushing companies to be more transparent and accountable to their shareholders.
A good reminder that M&A isn't just a game for executives. It affects everyone: shareholders, employees, customers, communities.
Absolutely.
Well, we've covered a lot of ground in this part of our deep dive. We've talked about asset and entity deals, negotiations, financing, due diligence, integration, and even emerging trends. Before we wrap up this episode, let's talk about one more aspect of M&A, the psychology behind it. It's not just numbers and contracts. It's also about human behavior and the decisions people make under pressure.
You're right. M&A deals are high-pressure situations. Billions of dollars, thousands of jobs at stake. It can really affect people's decisions.
So, in the next part of our deep dive, we'll explore the psychological side of M&A, the things that influence decisions over confidence, fear, regret. We'll look at the hidden biases that lead to mistakes and the strategies for making better decisions in this complex world.
It should be interesting.
It should be. Last time we were talking about the human side of these mergers and acquisitions. It's easy to get lost in the numbers, but we can't forget about the real people involved.
Yeah, it's important to remember that. And one of the biggest challenges after a deal closes is the integration process. Bringing two companies together on paper is one thing, but blending their cultures, systems, and operations, that's a whole other ballgame.
It's like trying to fit together two puzzle pieces that weren't really meant to go together.
That's a great way to put it. The success of a merger often depends more on how well the integration goes than the financial terms of the deal.
Communication must be so important in that process.
Absolutely. It's essential. Companies need to be upfront with their employees about what the merger means, what changes are coming, what the plan is for the combined company.
If people feel like they're left in the dark, it can create a lot of uncertainty and negativity.
Exactly. And it's not just about talking to employees, it's also about customers, suppliers, and the communities they operate in.
So it's really about considering everyone affected by the deal.
Precisely. Another crucial factor is strong leadership.
You need someone to guide everyone through the process.
Exactly. And it's not just the CEO either. You need strong leadership at all levels to help their teams through the changes, address concerns, and make sure everyone is working towards the same goals.
Okay, so we've got the integration process, the communication, and leadership. Let's get back to some of the mechanics. You mentioned asset deals and entity deals. Could you explain those a bit more and why a company might choose one over the other?
Sure. Let's start with asset deals. Think of it like this. The buyer is choosing specific parts of the target company: factories, equipment, patents, customer lists.
So it's a bit like picking and choosing what you want from a menu.
A very good analogy. The main advantage for the buyer is that they don't inherit any unknown liabilities of the target company. They're only taking on the liabilities tied to the specific assets they acquire.
So it's about minimizing risk.
Exactly. For the seller, an asset deal can be beneficial for tax reasons. They might pay less in taxes compared to selling the entire company.
Okay, so there are potential tax advantages. What are some of the downsides of an asset deal?
Well, negotiating and completing an asset deal can be more complicated and take longer for the buyer. Each asset needs to be valued and transferred separately, so it can involve a lot of paperwork.
I can imagine the lawyers would be happy about that.
Oh, they definitely are. Yeah. And for the seller, they might not get as much money for their assets as they would if they sold the whole company as a single unit.
It's a trade-off then. You have to balance the tax and liability benefits against the potential for a lower selling price.
Right. Now, entity deals are a bit different. The buyer takes over the entire company, including everything, all the assets, all the liabilities, contracts, and employees.
It's like buying a house and everything inside it, even the mortgage.
Right, exactly. It's a simpler transaction for the buyer. They get the whole package, no need to pick and choose.
What about the seller?
Well, they usually get a higher price in an entity deal because they're selling the entire business as a functional unit.
Like selling a business that's completely ready to go and the buyer can just take over? Are there any disadvantages to entity deals?
Of course. The biggest risk for the buyer is inheriting hidden problems. You know, those skeletons in the closet we mentioned.
Those hidden risks that you might miss during due diligence.
Exactly. Those become the buyer's responsibility in an entity deal. And for the seller, they might have to pay more in taxes compared to an asset deal.
So once again, it's a matter of weighing the pros and cons of each structure.
Precisely. And sometimes they even combine asset and entity deal structures to get the outcome they want.
So it's not always one or the other. Gaughan also discusses some more complicated entity deal structures: forward subsidiary mergers and reverse subsidiary mergers. Can you explain what those are?
Sure, let's say a company wants to acquire another company, but wants to keep the acquired company's operations separate. They might choose a forward subsidiary merger.
So it's like creating a separate branch for the acquired company.
Exactly. In a forward subsidiary merger, the acquiring company creates a subsidiary, and that subsidiary then merges with the target company. So the target company no longer exists independently, and all of its assets and liabilities become part of the acquiring company's subsidiary.
So it's a way to keep the acquired company and any potential problems it has separate. What about a reverse subsidiary merger?
Well, in that case, the acquiring company's subsidiary merges into the target company. The target company still exists, but it's now a subsidiary of the acquiring company.
So it's kind of the opposite. The target company absorbs the acquiring company's subsidiary.
Exactly. These subsidiary merger structures can be beneficial for a few reasons. They can simplify the transfer of assets and liabilities and make getting shareholder approval easier. Sometimes there can even be tax advantages.
Seems like there's a lot of strategic thinking when it comes to structuring these deals.
Definitely. Getting the structure right is very important because it can have significant legal, financial, and tax implications for everyone involved.
Okay, so we've covered the basic deal structures. What happens next? How does a company actually negotiate a deal once they've decided they want to acquire another company and figured out the structure?
It usually starts with something called a term sheet or a letter of intent. It's an initial agreement.
So this is like a preliminary agreement before things become official.
Right. It lays out the key terms like the purchase price, how the payment will be made, and the main conditions that need to be met. It sets the framework for the more detailed negotiations that will happen later.
Are these initial agreements legally binding?
Sometimes, depending on what's in them. That's why it's really important for both sides to have their lawyers carefully review everything.
Gaughan emphasizes the importance of confidentiality agreements in this phase. Why is confidentiality so important in mergers and acquisitions?
Think about it this way. When companies are exploring a merger, they share very sensitive information: financials, customer lists, trade secrets. If that information gets out, it could cause serious problems.
So confidentiality agreements are there to protect those sensitive negotiations.
Exactly. They also often include standstill agreements, which prevent the potential buyer from doing things like buying up the target company's stock or launching a hostile takeover, at least for a specific period.
So it's like a temporary ceasefire while they negotiate in good faith.
Right. Once confidentiality is in place and the initial agreement is signed, the next stage is due diligence.
This is where they really start digging into the details.
Yes. Due diligence is about verifying all the information provided by the target company, looking for any potential risks, making sure there are no hidden problems. They thoroughly examine the target company's financials, contracts, customer relationships, operations, even their legal and regulatory compliance.
I bet they find some surprises sometimes.
Oh, they definitely do. It's a critical step because it allows the buyer to make a well-informed decision about whether to move forward with the deal, and if so, how to structure it and what price to pay.
So even at this stage, the buyer can still decide to back out.
Absolutely. If they uncover any major issues, they can choose to end the negotiations. Or, if the issues are minor, they can try to renegotiate the terms.
Makes sense. Assuming everything goes smoothly during due diligence, what's the next step?
That's when the parties start working on the merger agreement. This is the final contract, the one that's legally binding and lays out all the details and conditions of the deal.
So this is where things get really official.
Right. The merger agreement covers everything, from the purchase price and payment method to guarantees made by both sides, the conditions that must be met for the deal to close, and even what happens if the deal falls through. It's incredibly detailed.
I imagine having good lawyers is essential at this stage.
Oh, absolutely. Once the merger agreement is signed, things are getting close to the finish line.
But I'm guessing there are still a few hurdles left before the deal can actually close.
You're right. Getting all the necessary approvals from regulators is often one of the final conditions. Remember those antitrust laws. If the deal could potentially reduce competition, The companies will need to get the green light from the relevant regulatory bodies.
So even if both companies are ready to go, the government can still put a stop to it.
That's right. And there can be other conditions that need to be met before closing, like getting approval from shareholders or hitting certain financial targets.
It's like a final checklist before the deal is official.
Exactly. The closing is when everything is finalized, all the necessary documents are signed, the purchase price is paid, and ownership of the target company officially transfers to the buyer.
It sounds like a pretty significant moment.
It can be a very exciting time for everyone involved. It represents the culmination of all their hard work.
Now, besides the legal and regulatory aspects, I imagine financing these massive deals can be a challenge.
Oh, absolutely. Financing a merger or acquisition can be incredibly complicated, especially when you're talking about large sums of money.
So how do companies actually come up with the money to buy another company?
There are a few different ways. They might dip into their own cash reserves, issue new stock to raise capital, or take on debt by borrowing money.
So it's like a combination of paying with your savings, trading some of your belongings, and taking out a loan.
That's a good way to think about it. The specific mix of financing they use depends on various factors like the size of the deal, the financial health of the company that's buying, and the interest rates at the time.
We've talked a lot about investment bankers. Can you explain more about how they help companies navigate the complex world of financing these deals?
Investment bankers play a vital role in advising companies on the best ways to finance a deal. They help them secure loans from banks, structure debt offerings, and even manage stock offerings to raise money.
So they're like financial matchmakers, connecting companies with the right sources of capital.
That's a good way to put it. They're experts in capital markets and have a wide network of contacts, allowing them to find the most favorable terms for their clients.
Now, Gaughan mentions leveraged buyouts, or LBOs, as a common strategy used by private equity firms. Can you explain what those are and how they work?
Sure. In a leveraged buyout, a private equity firm uses borrowed money, often a significant amount, to purchase a company.
So it's similar to using a mortgage to buy a house, but much bigger.
Exactly. The assets of the company being acquired are often used as collateral for the loan. The private equity firm then uses the cash flow generated by the acquired company to pay off the debt.
It seems like LBOs could be quite risky, especially if the acquired company's performance doesn't improve as expected.
They can be. LBOs are high-risk, high-reward propositions. If the company's performance improves, the private equity firm can make a huge profit. But if it struggles, the debt burden can become unsustainable.
It's a calculated gamble. Private equity firms are good at identifying companies that are undervalued and have the potential for improvement.
That's right. They often bring in their own management teams to improve operations and boost efficiency and profitability. If they're successful, they can sell the company later for a much higher price, generating a big return for their investors.
We've covered a lot of ground: deal structures, negotiations, financing, and the role of private equity. It's pretty clear how complex this world of mergers and acquisitions is.
Absolutely. And we haven't even scratched the surface of some of the more specialized areas like cross-border M&A, hostile takeovers, and the intricacies of antitrust law.
Well, we'll have to save those for another deep dive. For now, let's shift our focus back to the human element. We discussed the importance of communication and leadership during the integration process, but I'd like to hear more about how employees feel during these acquisitions. What's it like for them when their company is being bought?
It's an important question. Unfortunately, it often gets overlooked amidst the financial and legal details.
It's more than just numbers on a spreadsheet for them. It's their careers, their livelihoods.
Exactly. Depending on the circumstances, a merger can be a very stressful and uncertain time for employees. They might be worried about losing their jobs, having their roles change, or having to adjust to a new company culture.
I can imagine it's especially tough when two companies with very different cultures merge.
Absolutely. Cultural clashes are a frequent problem in mergers and acquisitions. They can lead to conflict, low morale, and even reduced productivity.
So what can companies do to help their employees through this and make the transition smoother?
Open and honest communication is key. Being transparent with employees about the reasons for the deal, how it might affect them, and the plans for the future can go a long way in reducing anxiety and building trust.
If people understand why the changes are happening, they're more likely to support them.
Exactly. And involving employees in the integration process, giving them a voice, can make a big difference.
So instead of just imposing changes, companies should try to create a more collaborative environment.
Precisely. And companies should offer support to employees during the transition. Things like training programs, career counseling, or even helping those whose jobs are eliminated find new positions.
It's about recognizing that these deals affect real people and providing support.
Exactly. When companies prioritize their employees' well-being during a merger, it makes the transition easier and can actually improve the chances of successful integration in the long run.
Because ultimately, the success of these deals hinges on the people.
You're right. A merger might look great on paper, but it's the people who have to make it work, adapt to the changes, and create the new company culture.
Okay, so we've talked about communication, leadership, and employee support during integration. You also mentioned fairness opinions. Can you explain more about how those are used to protect shareholders?
Sure. A fairness opinion is basically an independent assessment of whether the price being paid for a company is fair. Regulators or a company's board of directors often require them to make sure the shareholders aren't being taken advantage of.
So it's like getting a second opinion from an unbiased expert.
Exactly.
Yeah.
Let's say a company's board is considering selling the company to a private equity firm, and some of the board members have personal ties to that firm. That's a potential conflict of interest.
Right. It makes you wonder if the deal is truly in the best interest of all the shareholders or just benefiting a select few.
That's exactly why getting a fairness opinion from a neutral investment bank is so important. It reassures shareholders that the terms of the deal are fair and reasonable.
So the investment bank acts as an impartial third party, analyzing the deal and offering an objective assessment of its value.
Right. And fairness opinions are much more than just a rubber stamp. They're detailed reports explaining the analysis, the methodologies used, and the reasoning behind the opinion.
So it's about providing transparency and making sure the process is accountable.
Exactly. Fairness opinions are particularly important for institutional investors like pension funds and mutual funds. They have a responsibility to act in the best interest of their beneficiaries, so they need to be able to justify their investment decisions. Fairness opinions provide them with that justification.
So it's all about protecting the interests of the shareholders and ensuring that these deals are conducted fairly and transparently.
Precisely.
We've covered so much ground in this deep dive into mergers and acquisitions, from historical trends and financial mechanisms to the human side of these deals. What are some of the key things you hope our listeners will take away?
Well, I think the most important takeaway is to remember that mergers and acquisitions are incredibly complex and always evolving. There's no single approach that works for every situation. Each deal presents its own unique challenges and opportunities.
It's not just about numbers and contracts. It's about understanding the strategic thinking behind these deals, the legal and regulatory landscape, and the impact on employees, customers, and even the wider community.
You've got it. Another important takeaway is that a successful merger or acquisition requires meticulous planning, flawless execution, and a deep understanding of both the financial and human aspects of the deal.
It's about finding that sweet spot between having a strategic vision, being financially disciplined, and showing genuine concern for the people involved.
Exactly.
Now, before we wrap up this part, I'm curious about your thoughts on the future of mergers and acquisitions. What trends do you see emerging, and how do you think those trends will shape the M&A landscape going forward?
That's a great question. It's difficult to say for certain because the world of mergers and acquisitions is in constant flux, with new challenges and opportunities always cropping up. But there are a few trends I'm watching closely.
Okay, let's hear them.
First, I think we're going to see continued growth in cross-border M&A activity. Companies are increasingly globalized, so they're looking to expand into new markets through acquisitions.
So we can expect to see more deals involving companies from different countries.
Absolutely. And that brings a whole new set of complexities to the table, from navigating different legal and regulatory systems to managing cultural differences.
It sounds like cross-border M&A requires a specialized skill set. What other trends are you seeing?
Another one I'm watching closely is the growing role of technology in M&A. Technology is transforming every aspect of business, and mergers and acquisitions are no exception. We're seeing new tools and platforms that streamline the deal process, from due diligence to integration.
So technology is essentially making it easier and faster to complete deals.
In some ways, yes, but it's important to remember that technology is just a tool. Ultimately, it's the people using these tools who will determine whether a deal is successful or not.
Right. Technology can help facilitate the process, but it can't replace the human judgment and expertise that are essential for making sound M&A decisions.
Exactly. And another trend I'm seeing is the growing focus on environmental, social, and governance (ESG) factors. Investors are increasingly looking at a company's ESG performance when making investment decisions, and that includes their M&A activity.
So it's not just about financial returns anymore. It's about social responsibility and sustainability as well.
Right. Companies with strong ESG practices are seen as more attractive acquisition targets. They're perceived as lower risk and better positioned for long-term success.
It's interesting to see how these non-financial factors are playing a bigger role in M&A. Are there any other trends on your radar?
One final trend I'll mention is the increasing activism of shareholder groups. Shareholder activism has been on the rise in recent years, and we're seeing more instances of activist investors pushing for changes at companies, including influencing M&A activity.
So shareholders are becoming more vocal and assertive about their expectations.
Exactly. And that's putting pressure on companies to be more transparent and accountable to their shareholders, which is ultimately a positive development.
Right. It emphasizes the fact that mergers and acquisitions are not just a game for executives and investment bankers. They have real consequences for a wide range of people, including shareholders, employees, customers, and the community. Well, we've covered a lot of ground in this part of our deep dive. We've explored the nuances of asset and entity deals, the negotiation process, the challenges of financing acquisitions, the importance of due diligence and integration, and even the emerging trends that are shaping the future of deal-making. But before we conclude this episode, I think it's worth exploring one final fascinating element of M&A, the psychology of deal-making. It's not just about numbers and contracts. It's also about human behavior, the emotions involved, and the sometimes irrational decisions people make under pressure.
You're absolutely right. Mergers and acquisitions are incredibly high-stakes situations. We're talking about billions of dollars and the livelihoods of thousands of people. That kind of pressure can definitely influence people's decisions.
So in the next and final part of our deep dive, we'll explore the psychological side of M&A. Those things that can affect decisions over confidence, fear, even regret. We'll uncover those hidden biases that can lead to costly mistakes and look at some strategies for making more rational decisions in this complex and often unpredictable world.
I think it'll be a great way to wrap up our deep dive.
So we're diving into the psychology of deal-making now. What are some of the big psychological factors that influence these high-stakes negotiations?
Overconfidence is a big one, especially for the acquirer. They might overestimate their ability to integrate the other company or underestimate the challenges. Sometimes they just get so caught up in the excitement of the deal that they overlook red flags.
It's like they have blinders on.
Yeah, exactly. And that overconfidence can lead to what we call the winner's curse, where they end up paying way more than the company is worth.
Like getting caught up in a bidding war and losing sight of the actual value. Are there other biases that come into play?
Oh, definitely. Confirmation bias is another common one.
Right.
That's where people tend to look for information that supports what they already believe and ignore anything that contradicts it. So if a company is convinced a deal is good, they might downplay any problems that come up during due diligence.
They only see what they want to see.
Right. And that can be a recipe for disaster. Then there's the anchoring effect, where the first piece of information you get really sticks with you and influences your later judgments. So if the initial offer price is high, it can set a high bar for the final price, even if the company isn't actually worth that much.
It's like getting stuck on that initial number.
Exactly. And all these biases can get amplified by the competitive nature of mergers and acquisitions. When you have a bunch of companies fighting over the same target, it creates this sense of urgency, this pressure to win, and that can lead to even more impulsive decisions.
It becomes an emotional game.
It does. And just like in any high-pressure situation, it's crucial to keep your emotions in check and make decisions based on the facts, not ego or fear of missing out.
So how can companies avoid those psychological traps and make smarter decisions?
Having a clear and specific acquisition strategy is key. Knowing what kind of companies you want to acquire and why, setting criteria for evaluating targets, and having a solid integration plan can help prevent impulsive decisions driven by deal fever.
It's like having a roadmap to guide your decisions.
Exactly. Building a strong and diverse deal team is also crucial. Having different perspectives and areas of expertise on your team can help you see things from all angles, challenge assumptions, and make more balanced decisions.
It's like having someone there to play devil's advocate and make sure you're not missing anything.
Exactly. And finally, having a thorough due diligence process is crucial. Don't just take the target company's word for everything. Do your own research. Talk to their customers and suppliers. Really get a comprehensive understanding of the business.
You have to dig deep and make sure you know what you're getting into.
Yes, exactly. By taking those steps, companies can increase their chances of making good, rational M&A decisions that benefit everyone involved.
Well, we've covered a lot of ground in this deep dive into the world of mergers and acquisitions. We've explored the different types, the laws involved, how deals are structured and financed, the importance of managing the human side of things, and even the psychological factors that can influence decisions. As we wrap up, I think it's safe to say that understanding the financial and legal side is essential, but being aware of the psychological aspects is just as important. Companies can make better, more strategic, and more successful decisions by recognizing and mitigating those potential biases.
I completely agree. Mergers and acquisitions are a fascinating and complex area of business. Understanding the dynamics at play gives us a much better appreciation of how the business world works and the human stories behind these huge deals.
Thank you so much for joining us on this deep dive. We hope you've gained some valuable insights into the world of mergers and acquisitions. Until next time, keep learning, keep exploring, and as always, keep asking those great questions.